Let's focus on another set of earnings, and we've got the management of Redington joining in on the show right now. VS Hariharan, the MD and Group CEO, joins in to chat about how their earnings were and what's it looking like going forward as well. Mr. Hariharan, great to have you today on ET Now. Thank you so much for your time. Your top line has grown over 34.5% against the estimate of 29,700 thereabouts that the street was actually working with. That's a very, very sharp beat. Congratulations, firstly. But tell me, how much of this is durable? And more importantly, annuity-like demand versus a one-off pull going forward, especially with growth strongest in markets like India, South Asia, and Singapore for you.
All right. Thank you so much, Aisha, for having me on the show. Yes, we had a fantastic quarter, the highest revenue ever, the highest profit ever. Normally, Q1 is a little bit of a low seasonality quarter for us. Like you said, 34% top line, 77% bottom line, 35,000 crores of revenue, 486 crores of profit. We are very proud of what has been achieved. So if you look at the engine of the growth drivers here, India did fantastic for us, clearly, over 60% growth. South Asia, as you mentioned in your message as well, we did well. Middle East Africa, which has actually been hurt by the West Asia crisis, grew 15% for us. And there were pockets of very decent growth, like Africa was a good growth. The GCC Levant regions was a good growth. We had muted growth or negative growth in UAE and Saudi because of the West Asia crisis and some of the demand softening there, but it is still better than we thought. So overall, geography was good. Now, if I look at business units to give you a perspective for what's going forward, all four business units we have, whether it's mobility, endpoint devices, the technology solution, server storage, and the software solutions, all grew strong double digit. Across the board, and India in particular, even faster. What is driving it? Clearly, we can see a demand spike for AI, GPUs in TSG, and the data center business. We are seeing a good growth in software solutions, really driven a lot by us trying to gain share there. And on the endpoint side, the price increases due to the component shortage has helped us to get our ASPs, average selling price, and the higher revenues. And premium phone consumption continues to outpace the overall smartphone market, and we play into the premium phone market. I would say, as we look forward, clearly a lot of this is sustainable. The only area of concern for us, because of the price increases on PCs and smartphones, at some point we could see a consumer demand softening. We're already seeing unit growth is flat to single digit. Because of the price increase, we're getting some of the revenue increases. Now, how much can that sustain beyond the next few quarters? We'll just have to wait and see.
The other thing that I, observed also is that your EBITDA margins expanded about 2% from the earlier 1.5%. Having said that, your consolidated gross margins have actually seen a dip. Now, I understand that it's the ex-Arena margins, which is currently at play. But what I want to understand is how much of the reported margins is actually an improvement in the genuine operating leverage sense versus Arena drag sort of masking the operating leverage for you?
No, it is there is a genuine leverage. Very good question. But if you look at excluding Arena, there is a genuine leverage that we see. Our OPEX grew single digit this quarter when everything else has been double digit. And we are getting leverage because we are generating much higher revenues on the same OPEX base. But if you specifically look at the mix of businesses, because Software Solutions Group is growing faster than the rest of the business and delivers a 6% plus gross margin this quarter, that gives us a better boost as well. And on the PC side, the higher ASPs has delivered a slightly higher gross margin. So clearly there has been leverage. There has been some specific factors because of mix as well as the PC price increases. All of that has contributed to the margin. I would say we want to be able to sustain. That's our goal, to be able to sustain and improve and on the gross margin side. Clearly, a lot of things at play right now, too many variables at play, but our intention is to continue to grow the gross margin and the EBITDA.
And how much of that gain will come from the SSG and how much of the gain will come from your traditional businesses? Because SSG was, I believe, sub 1% of your top line, FY26. So can you give us a sense as to how the revenue mix is shifting and how that is likely to impact your margins?
No, so it's not 1%.
Okay.
The SST mix of the entire business is 17%
Okay.
top line, and the bottom line will be more than 17% because it delivers higher than
Higher.
average
Yes.
bottom line. And that will continue to grow the SSG mix within the business as it grows faster than the rest of the mix. So that's clearly one bottom line contributor in terms of growth. But we have even on the our TSG business now is picking up momentum. So the run rate business on TSG, we are trying to grow the gross margins there. It is hyper competitive. And on the PC side, the higher price points that I mentioned will continue to give us some additional gross margin moments there. But clearly, the key driver is going to be on the gross margin, and the EBIT driver is going to be software solutions and the professional services inside it, which is now 17% of the mix.
Understood. But you've also guided Arena losses to shrink in FY27, right, Mr. Hariharan? What I wanted to understand is how much of your group margin recovery story hinges on that premise? And should there be a delay, then what happens?
We did guide that we'll get better, but what we are seeing after exiting from the Lira business in Turkey, the size of the business has shrunk, but the gross margin, there's a gross margin compression as well. So it is going to take a little longer. We'll have to do some restructuring there in the Arena business to get us to profitability levels. So we do see a few more quarters of work to get there. We are headed in the right direction. But what we see is our other constituents, whether it is India or Middle East Africa, are definitely delivering both revenue and profit growth better than we expected as well. So that should compensate. So if I look at the future outlook on profitability, not concerned. We will have to work the Arena problem in the next few quarters to solve that.
So you're seeing a delay beyond FY27, is it?
No, it is definitely, it will be solved. We have a strategic approach on Arena, and we will solve the problem within FY27. So we hope as we get into FY28, we're not carrying that problem of Arena. Yes.
Last off, Mr. Hariharan, I'm trying to understand. You would obviously be carrying some inventory, and the kind of pricing that's playing out in the market means that the inventory that you carry has a better resale value. How much of that is proving to be a tailwind in the current margin number that you're clocking? Because I'm sure that there is some amount of tailwind that you're seeing there.
I would say definitely a small amount, but it's not significant. Why is it not significant? Because this only helps for the stock and sell business for endpoint solutions. Most of the sales we do on technology solutions is largely back to back. Software solutions is back to back. There's an end customer involved, pricing is decided, etc. And on the PCs, all back to back deals, and mobility is a high velocity business. So only on the endpoint solutions, wherever we stock and as the prices go up, there is a little bit of a margin effect there because of the price changes. But I would not say it's significant.
Last off, Mr. Hariharan, just on the AI capex and data center capex cycle, which is at play, you're obviously benefiting from that. Your top line is benefiting from that. One, sustainable, and two, what if the global AI capex cycle were to reverse? Is there a risk there?
Yeah, there is so if I look at AI capex, there are two parts to this. One is the AI GPUs that we sell within the technology solutions. So the data center business was only accounted for about 700-800 crores this quarter. We do have a very healthy backlog, multiple times that for the next few quarters. So there's not a very big number baked in terms of what we are doing today, and we are delivering what we're delivering despite that. But clearly on the PC side, on the commercial PCs, there's a penetration of about 36% AI PCs. But as we go forward, all PCs are going to become AI PCs. That's going to be the new normal. And then the run rate servers we sell in technology solutions is also going to become AI GPUs are going to become run rate. So there is not a lot of AI capex built into us, our numbers today as such. So it can only get us an upside. I don't see a downside from an AI capex cycle perspective.
Thank you so much, Mr. Hariharan. This gives us good clarity on the numbers. Congratulations on a very strong set. Of course, the stock perked up 10% as a result of that. And thank you so much for the conversation.
Thank you so much. Thanks.